Hey traders, Jason here from Leavitt Brothers. Happy Monday. In this video, I'm going to do an update of the state of things. 2 weeks ago, market breadth started to weaken. Then last week, the weakness intensified. The market is now at a sensitive spot. The indexes have come down off their highs and don't seem to have much room for error. So today I'm going to drill down with the S&P charts, the monthly, the weekly, the daily, and then I'm going to look at a few indicators that I don't normally talk about in these videos. All right, let's get started. So here is the S&P 500 monthly with 10-month moving average. So you could see the 10 acts as a pretty good dividing line. It often acts as support and resistance. So you can see here support here, resistance, kind of gets scooped up over here. Okay, you get the point. Look at the support all the way up here. Boom, boom, boom. Okay, and then it continues up. All right, so what I want to do here is I want to compare the current market structure to a couple previous areas. Okay, so first we have 2007, 2008. Okay, and you can see here it kind of here was your topping pattern. And you can see that the index traded above the moving average. Then the moving average acted as resistance there, and then one more time right there, and then it continued down. Okay, if we compare that to 2014, 15, 16 area, there's your range. Okay, you see the moving average acts as support here, but then you see the index drops below it, but then recovers. Okay, it drops below it, then recovers. So this is unlike back in 2007 where it lost it and then just acted as resistance and acted as resistance again. So it recovered, so it wasn't as bad. Then when the index broke out to a new high here, it paused for a couple months and then obviously it continued on. So if I compare that to what's currently going on, I can't draw a nice box as I did in the previous two times, because you have higher high going like this. You have lower high going this way. If you want to stretch it, you can even if you ignored last December and January, you almost have parallel trend lines here. It's a nice channel up, and then also it was similar to 2016, you have a new high and then you have a couple months of sideways trading. So in my opinion, like, the current situation doesn't too closely resemble either of the last two, but it certainly more closely resembles 2015-16, where the index broke out to a new high, paused for a few months, and we'll see what happens from here. But we certainly don't have a situation where the index has dropped below its 10 and then is struggling to recover. If the market falls here and the 10 kind of comes like this and the market comes up and gets rejected and goes down, then all bets are off. The situation will change. But for now, the market's in good shape overall. It's simply moved to a new high and now it's pausing. And I think, so overall our bias needs to be to the upside. It's only if this thing drops below the 10 and then fails to get back above that I'd start getting worried. And this being a monthly chart, that's going to take several months to play out. It's not something that happens in a few weeks. It's going to take us several months. All right, here's the weekly. So it's the weekly with the 50-week moving average. As you can see, we have, support here, support, a little bit of resistance there, support. So the 50 is actually very important. I've noted this many times. Let's look at some of the indicators here. So MACD histogram, we have a negative divergence as this moves up, allowing for a little dip below. I usually don't like a dip below, but I'm noting it right now. So we have a negative divergence, and then what we have here is right now the MACD hasn't been able to cross back up. Okay, so you can see the red line here is right there, and then the black line has come up and it's starting to curl down. So if this thing gets rejected, that's going to be very bearish. Okay, that's a classic, cross down, come up, kiss it, and then continue down. Now, if if the MACD just trades in a range like this, it's perfectly fine. The MACD can move up to a high level and move sideways in a range for quite a while and support the market. It's only when we get like a distinct move down and then failure to cross back up that things become a problem. So that's something I'm looking out for right now. The market itself is up near a high, so that's good, but we're starting to get some weakness here with the MACD, and then the stochastic is actually trying to cycle down. So what I'm looking for right now is, or if you're bullish and you're hoping the market goes up, you want the MACD to be able to move sideways while perhaps the stochastic cycles down and then comes back up. So if this can move sideways while the stochastic cycles down and moves back up, the market should be in good shape. But if this thing actually rolls over and goes like this, market's going to probably fall. All right, daily chart here. Okay, I want to point out, first I want to point out like what I consider to be an absolutely perfect setup, and then I want to relate it to what I see here. So we have higher high, two higher highs here, and the MACD, we have two lower lows. Then we have a cross right here, the MACD. Change my color here. Then what you have is a classic kiss. Okay, so here's the red line here. Okay, and then the signal line, the black line, it comes up, kisses it, and moves down. Okay, it does that at the same time that the market moved up. Okay, so this to me is a perfect sequence of events where you get higher high, divergence, cross, and then while the market makes one more rally attempt, you get a kiss from the MACD, and then you get a cross from the stochastic, and then the market obviously goes down. That to me is a perfect sequence. It plays out at tops and at bottoms. So if I relate it to today, we didn't get any type of divergence, but we do have a cross here. Okay, so we do have a cross here. So from here, we have the red line here. If the black line comes up here, kisses it, and goes like this, the market's heading south. Okay, it's as simple as that. The market's not going to be able to withstand that. Okay, but if the black line can cross back up and go sideways, kind of like the weekly, then the market will be fine. Okay, the moving average here is the 50, and it's in pretty good shape. So as long as the S&P is above here, if the MACD can move sideways, we're fine. If we get a kiss here, then the market is going to leg down. All right, now let's look at a couple indicators. So up top we have S&P. In the middle we have the high beta S&P stocks. It's the 100 highest beta stocks in the S&P 500. And then we have low volatility, which is the 100 lowest volatility stocks in the S&P 500. Okay, a couple things I want to point out here. And this is a little bit worrisome for right now, is that we have a new high here. Okay, but the high beta stocks failed to put in a new high. Okay, and that was a warning, and the market dropped. And if I relate that to today, we have nearly a new high. It's up near its high, but we have a very obvious lower high. Okay, this is an issue. Okay, this is kind of like these are the high beta stocks. These are more growth stocks. These are stocks that are more volatile. And when the market goes up, if they fail to match the high, it's a little bit of a warning that money is coming out of the growth stocks and going into lower volatility stocks, and that's a warning. Okay, so this, I would consider this to be an issue right now. If the market does actually move up here and attempt to rally, if the high beta index doesn't do the same, but instead just kind of goes up and matches a high and drifts around, we're going to get, I'm not going to predict that we're going to get a repeat of last fall where the market completely fell apart, but the market will not rally much if the high beta stocks do not participate in the move. All right, next chart is the Russell 2000 versus the Russell 1000. So it's basically the small caps versus the large caps. All right, so what I want to point out here is going back to last August, the market obviously rallied all the way into January, not last August, August of 2017. The market actually rallied all the way into January 2018. At the beginning of the move, for about 6 weeks, the small caps outperformed the large caps. You can see that. Okay, so they outperformed for about 6 weeks, and that's about the same size as this line here. And then they started to underperform, but that outperformance for 6 weeks was enough to enable the market to achieve, quote unquote, escape velocity and continue on. Okay, if I look at another time frame, so we have this rally here, and again, small caps outperform large caps for several months, enable the market to achieve escape velocity, and then the market is able to continue on even though small caps then start underperforming. Same thing happened at the beginning of this year, where the market obviously rallied huge off the December bottom. Small caps outperformed large caps for about 2 months. That enabled the market to achieve escape velocity, and then momentum carried it further. But right now, small caps only outperform large caps by for like 2 weeks at most. Okay, that's not enough. Okay, that's not enough. Okay, in each one of these cases, the small caps led for like 2 months. That was enough to give the market momentum to keep going. And then even though the small caps pulled back, the market was able to propel itself forward. So this outperformance right here, that's not enough. 2 weeks of outperformance isn't enough to allow the market to gather that momentum to keep going. So if the market is going to rally, we need this, Russell 2000 versus Russell 1000 to go up. Okay, small caps need to outperform for long enough for the market to gather momentum and achieve escape velocity, so that even when they pull back, the market can continue on. So we're not getting it yet. It needs to happen. Okay, one more chart. Here up top, down below is the S&P 500. Up top is the AAII bulls minus the bears. I want to point out a few things. So on the downside, you get low prints, and low prints tend to coincide with lots of fear in the market, and those are what produce bottoms. So you have a low print there, and the market bottomed and moved up. You have low print here, and the market temporarily bottomed and moved up. Okay, so I want to compare the current situation to the one that's most similar to it in the past. Here you have a really bearish period. Okay. And so you have really low prints from the bulls minus bears, but it progressively gets less worse, and then it moves above zero, one dip below, and then it gets above zero and stays there for several months, and this propels the market. This propels the market higher. Okay, if I can compare it to today, you have a similar setup here. We have several months of really bearish readings which act to pound out a bottom. The readings get less worse, okay? And then you get some prints, you get prints above and then a couple of prints below. Okay. Now, a lot of people like to just blindly think that you need to be a contrarian, that like when everyone's negative, you should be positive, and when everyone's positive, you should be negative. It's not actually the case. When you get these really low prints, that's going to pound out a bottom. But once the market starts moving up, you actually need prints above zero in order to confirm the move. Okay, so we have 2 consecutive weeks where we prints below. We need prints up here. Okay, if we continue to get prints down here, boom, 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 the market's going to turn right back around and just go south. Okay, now that we've gotten a bottom put in place and the market's moving up, we need prints above zero in order to confirm any type of rally attempt. Okay, so between the high beta stocks that are lagging, the small caps that are not leading, and the AAII bulls minus bears not being above zero, a rally attempt is not supported right now. If the market tries to bounce, as it is today, these indicators must confirm the price action. Otherwise, the market will head south again, or I should say maybe continue heading south because it's already been moving down a little bit. All right, thanks for listening, and I'll see you next time.